Welcome back to the Financial Beast Podcast. I am your host, your BFFF, best financial friend forever, Eric Miller. And we just did another Between Two Erics. And this was done with my other financial advisor, Eric Gersch. And it was a topic that we just had some fun with. It was, hey, what do you do with $400,000 or $500,000 just sitting in cash? Now, we'll routinely talk with business owners, practice owners that have accumulated a lot of cash. And the question that we'll get is, hey, what do I do with this? So we really broke down our thought process of what to do with that money, because if you don't have a purpose for money, then it eventually will disappear. So we tackled where to allocate it, how to invest it, and a lot of other things that I think are going to be of high interest to you. So definitely tune in for the entirety of the podcast. I think you're going to absolutely enjoy it and get some gold nuggets from it. As always, please like, share, subscribe our podcast, and leave a review if you could as well. And if you are in need of financial help, if you own a practice, a healthcare owner, if you know someone that is owns a healthcare practice, please direct them to our website, Econologics.com, and they can schedule an intro call so they can get started on improving their financial lives and being able to live the life that they want to live. Okay, I'll see you guys on the next podcast. Enjoy. All right. Welcome back. So what we discussed on the before the podcast was we didn't have any idea what we were going to talk about. And then, of course, I, being the idea guy that I am, I had to come up with this topic.
You're creative. I'll give you that.
Yeah,
I'll give you that. I like this topic. I think this is a great one because it's
going to be fun.
Something
it's gonna
different.
Be fun. Yeah, it's going to be fun. Plus, it's a scenario that we see quite a bit with people that own a business or whatever, or healthcare owner. In that, what would you do with $300,000 or $400,000? We'll say $400,000. Keep it semi-even. Okay. So where this came up from is that we'll routinely see a lot of business owners that will just have like $500,000, $300,000, $400,000 just sitting in cash.
Yes.
It's either in their business or they've taken it out, but it's just sitting in their bank accounts.
Yep.
And a question that we'll always get is, well, what do I do with it? I don't know what to do with this money. Yep. So we want to break down some things that we would do when presented with that situation and make sure that you're allocating the money correctly. Because here's one thing I do know. If money is just sitting in an account and it doesn't have a purpose to it, at some point in time, it's going to get spent.
Agree.
It may not happen tomorrow. It may not happen tomorrow. It may not happen the next day. It may be a year from now. It's going to get spent.
And I think right now this is a bigger issue, if you want to call it that, but it's a more frequent issue because bank interest rates are high. Mm-hmm. So people don't really see 300, 400,000 sitting in cash as an issue if they're earning 4.5% to 5%.
Yeah.
You know, if bank rates were at 1% or whatever they were pre-COVID, it would be a completely different situation. People would be, I think, more motivated to do something with their money. But when you're earning 5% with quite literally no risk or as close to no risk as you can get, it's very easy to get comfortable and just let that money sit.
Yeah. I mean, look, we had basically zero interest rates for 20 years, somewhere around there.
Yeah.
So you didn't earn anything on your checking and savings accounts. And now all of a sudden, oh my God, I got $500,000 in my account and I'm making $25,000 a year in interest. Yep. That's pretty good. Like, I don't know where else I'll do that with less risk, but the issue is that, is that really the best place for that money? And I think the first glaring, when you hear that question, like I got a bunch of cash and I don't know what to do with it. I know your eyes light up and you're like all happy inside when you hear that, by the way.
A little bit.
Yeah. But the first glaring out point that creates in me is that this person does not have a plan. Because if you had a financial plan or even an advisor that wrote you a financial plan, there would be an allocation that's already predetermined of where your money is going to go or where your profits are going to go for your practice. Right. So I think to me, it represents someone that does not have a plan long-term, and that needs to get corrected immediately.
Agree.
Aside from what to do with the money, you got to get a plan together. So, because again, I'll just go back to it. If you don't assign a purpose to a money, then it's just gonna disappear. So,
and I think the second out point that pops up to me is an asset protection point, right? If this money is sitting in your business savings account, it is in the name of the business.
Correct.
Well, where is your highest lawsuit risk, if you will? Is it you personally, or is it your practice getting sued? Your practice.
Yep.
So why do we want to keep oodles and oodles of money in the practice's name? Our goal should be to get it out of that entity to ourselves personally, where if our practice is sued, it's not going to be reachable.
Correct. So there is an asset protection discussion that you'll have to make sure that the cash, isn't a target if there is a lawsuit, which it absolutely would. And the business,
lawyers love cash.
Yeah. And the business is the highest liability aside from your real estate. I mean, your business is the rental real estate. Your business is the highest liability asset that you have.
Yeah. Oh, yeah.
Aside from like a drinking problem. That's a different discussion right there.
Where did that come from?
A person can be their own worst enemy, Gersch. You've seen that before, haven't you?
Are you manifesting?
No, not at all. I'm just saying. I mean, this is this is reality.
No, you're not wrong. You're not wrong.
This is why we need personal umbrella insurance and all other things too from an asset protection standpoint. Okay, great. So, but that still didn't answer the question. Person's got $400,000 or $500,000 sitting in cash. What are you gonna do with it?
Well, number one, I think the first thing you have to look at is how much cash should this person have in the business.
Yep.
Because even though, asset protection conversation aside, your business needs money to run and your business needs reserves. I know for our firm, we recommend about 60 days worth of expenses. Now, there is some wiggle room there depending on practice size. A practice that's doing $400,000 a month doesn't need 60 days of expenses, whereas a practice that's doing $40,000 a month, you could justify that. So let's say 30 to 60 days, depending on practice size.
I'm good with that.
So number one is figuring out.
Let's say that was 100,000 for this person then.
Okay, perfect.
So we're just going to keep 100. We're going to keep 100,000 in the business savings account. Then,
yep.
Right?
So 100,000 is not moving.
Okay. That leaves me 300,000 left over.
The 300,000 left over from there should be moved, and it should be moved, like I said earlier, to a personal account to get it out of the business entity.
Yep.
Now, what type of personal account? I mean, this is going to vary person to person, risk tolerance, what their other assets look like, how long they're going to continue to work. I mean, there's not like a blanket recommendation here. I mean, for some people, I might take that whole 300,000 and put it in stocks. For other people, I might take that 300,000 and put it in boring old U.S. Treasuries. The asset allocation is going to vary, but I think the stable data, if you will, is that money needs to be invested. It needs to be earning money.
Yep, I agree. So when we're talking about, I'll go even before that, one of the things that you would need to do is, number one, if you got a practice where you just have $300,000 or $400,000 of accumulated cash, I mean, that's a good sign.
Oh
That's
yeah,
like,
your practice is doing well.
Yeah, your practice is doing very, very well. So I would look at like, what is causing this to happen? And is there anything that you can do to strengthen? Because obviously you have good production. You must be seeing a lot of new patients. You got a good system for, collecting money. You have good control of money.
Good profit margins.
You
Yeah,
got great,
all
you got
those
great
things.
profit margins. So, I would probably look at, even reinvesting back into the business into some degree to strengthen some of the things that have caused this amount of money to accumulate.
Yep.
And maybe that's hiring another person. Maybe that's looking at a different location now, because that's usually an indicator. If you start getting like to that point right there, I mean, you have to be doing maximum production to get that kind of spread, right?
Generally, yeah.
Yeah. So I guess I'm at this point in time, I'm starting to look at your business expansion. Like,
That's a very good point.
What are some things that you could do that would allow you to create this scenario over and over and over again? So that would definitely be one place that I would look. I would 100% look at.
Yeah, that's a phenomenal point. I mean, even smaller scale business investments like adding an additional exam room.
Mm-hmm. Yeah, because you've already demonstrated that you know what you're doing.
Yeah.
Right. So it would just be, how can I increase this value now of this practice that's not I've been able to accumulate, 500,000 or 600,000. Why can't we just continue to do this? So that would be one thing. What caused this amount of money to be created in the first place? And maybe just throw some reinvestment back into that entity, because the business caused it.
Yeah.
Right. So the business was the thing that created that. Okay. So, all right. So let's assume that, part of our wealth building blueprint is we got 3 different buckets of investments that we look at. We look at real estate, insurance-based products, stocks and bonds.
Yep.
Okay.
The big 3.
So, yeah. So, and, this is what I say. Some of the reasons that we utilize these is that, number one, these 3 types of assets have traditionally been able to provide cash flow for the household in some capacity. It provides guaranteed income. There are some tax benefits, and the capital appreciation does occur that generally will outpace the inflation rate. Now, I don't get that from all 3 from any one of those individually, but collectively, when you look at all 3 of those, you're
going to get all 3 of those. Yeah, you're going to get all those attributes.
Yeah,
you're not going to get each attribute from each one, but
right.
Yes,
because each one will have its own risk. So I think breaking that down is like, okay, well, that's probably a good place to start. Let's talk about the stocks and bonds. Now, would you just dump? Let's say we decided of the 300 or 400,000 left over, we're going to allocate $100,000 into stocks and bonds. And
okay.
We're not giving investment advice right here. We're just giving a scenario here of things that we would look at. Would you just put it all in at once? Would you allocate it over a period of time? Like, what's your thought process right now on that?
100,000 is, while it's a lot of money, it's not a lot of money. I would lean towards the side of just invest it all at once.
Okay.
And look, I'm all for dipping our feet in the market and putting it in over a period of time. I mean, I do that with my clients every single day.
Mm-hmm.
But on 100,000, I'm probably just dropping it all in at once.
Yeah. Now, of course, we're going to ask, like, when is this money going to be needed as well? If this money is going to be needed.
There's a million and one factors that are discussed before. This isn't like a across the board answer.
Correct. But most likely there is going to be some allocation to a stock and a bond portfolio of some mix.
Yes.
And that's going to be predicated upon what the person already has. It's going to be predicated upon how much risk they're already taking. It's going to be predicated upon how much tolerance for risk that they have.
Yeah, and there was actually a study, I think it was done by Vanguard, if I'm not mistaken. It came out earlier this year that lump sum investing, like dropping it all in at once, has actually outperformed dollar cost averaging, putting it in periodically.
Mm-hmm.
About 50% of the time. So it's a big toss up between the two. There's not a clear winner in the race.
Yeah, because no one has any idea what's going to happen the next 20 years.
Yeah.
Because it was probably I can see how that would be. You put a lump sum in 20 years ago, as opposed to dollar cost averaging, you definitely are going to come out ahead.
Yep.
Yeah, because the markets have been pretty awesome for the 20 years. And you wouldn't have missed out on any of the upside at that point.
Yeah,
I can totally see what that would be. Now, is that going to be the case for the next 20 years, or is there going to be
I wish I knew.
That's what I'm saying. So I don't think there's a right or a wrong answer here. What are we trying to do here? We're just trying to create a scenario where this money is getting invested, is being put in an intelligent type of portfolio that is going to, provide an overall return that otherwise you're not going to get just sitting in cash.
Yep.
Simple as that. Okay. So then, okay, great. So then we're looking at insurance-based products. What are we looking at there?
Life insurance, annuities.
This is going to be dependent upon the person.
Yep.
This is definitely going to be dependent upon the person.
Dependent on their age, their health.
Yeah. So we would use a mixture of cash value life insurance and or an annuity contract. Now, why in the world would you do any of these things? Don't you know these things are just a ripoff, and that all you're doing is trying to make commissions, and the returns are going to be terrible, and the expenses are going to be, incredibly high? I mean, what kind of a fiduciary advisor are you, Gersch?
It's not all true. That is not true.
It's not?
Nope.
Dude, that's all I hear from fee-only advisors. That's it. So that disabused me of why in the world you're going to take people's hard-earned money and put them in these insurance contracts.
Well, let's beat up the
how dare you?
The commission aspect, because that's the most common that we hear.
Yeah.
Commission, right? And yeah, life insurance pays a commission. It pays a nice commission. I like it. And you do make more money initially off life insurance than you do putting it in a fee-based or fee-managed account.
Mm-hmm.
But over the next 20, 30 years, that life insurance pays that big commission up front and done. Whereas that fee account, let's say it's 1% of 100,000, it's $1,000 this year. Next year, if that account's worth 110, it's 1,100. 20 years from now, if that account's at 300,000, now it's 3,000 a year. So that fee creeps up, and that's not a bad thing. Look, I'm not here to knock either commissions nor fees. I mean, financial professionals have to get paid for what we do, and neither commissions nor fees are inherently good or inherently bad. It's just, I guess, is the person who's earning them, is the advisor doing what's best for the client? And if that advisor is doing what's best for the client, I don't really care if it's called a commission or called a fee. At the end of the day, it's cost of doing business.
It's compensation of some kind.
Yeah.
Doesn't matter where you put your money. There's going to be a compensation that's paid to somebody for that. And the only difference between the insurance and and I guess the fee-based model or the fee model is that most of the commissions are paid relatively upfront. On cash value life insurance, it would be. And then there's no more paid out to the person, the agent. That's it. That's all they get. And unless you're putting some money in, there may be some trails.
Yeah, there's small trails.
Yeah, they're very small.
But it's not, the trails on a life insurance aren't going to be comparable to the trails on a managed account.
No. And I think, again, was the policy designed correctly? Was it designed where there's an end result that we're trying to get? Was there a purpose to this? Is it going to protect your money? Is it going to provide some kind of tax-free income to you? I mean, these are all the things you have to look at. It's the design of the contract that's most important. And everyone can get into their little bickering wars about, this type and that type, but it's inconsequential because your advisor should have a good, legitimate reason. This is what we're trying to accomplish here. We need to carve out a portion of your portfolio that's going to create guaranteed income at some point in time. Because how many times have you seen clients when they've sold, and we carve out, $50,000, $80,000, $100,000 of just guaranteed income, coming from their insurance contracts and their Social Security. How happy are they to have at least that?
They're thrilled.
Yeah. It's like, I don't have to worry about this part right here. This is guaranteed. Okay. And I still have plenty of money left over to invest in the markets or to invest in real estate and to do all these other things. But I did a responsible thing. I took a lump sum of money and I put it in a place where it's going to guarantee me a guaranteed income and potential tax-free income for the rest of my life. Tell me where that is not prudent to do for anyone. It's not. Yeah. So commissions aside, I mean, I've never seen scenarios where we would not have made more money putting people in like a fee approach over a 20 or 30 year period than an insurance contract. Now we do both. We do both because I don't think we're pigeonholed into one strategy. I don't think that in our philosophy is a little different where, I mean, I've ran into some advisors where they're just like, it's all public securities, marketable securities, ETFs, mutual funds, and that's it.
Yep. That's all they do.
That's all they do. And and real estate and insurance-based contracts are just a pariah based upon what you're going to earn in the markets if you stay fully invested, buy and hold, and never sell. That's it. There's no risk management at all that's done with that. Okay. So I think we killed it on insurance-based contracts. Let's go to real estate. Yes. What are you doing there? So let's say we allocate 100,000 to some kind of a strategy where the person's going to take a lump sum, put into an insurance-based contract. And then what are you doing with the real estate?
Well, with the real estate, I mean, once again, it's going to be situational dependent, but you got a couple key options, I think. Mm-hmm. Number one is if you own any existing non-primary residence real estate, so any rental real estate, be it residential or commercial. Option one is pay down the debt on it, right, to increase cash flow.
Got it. Okay, so get rid of the debt. So whatever the rental income is, you're gonna create the ability to get the majority of that quicker.
Exactly. That's option one. Option two would be to put it into some sort of real estate fund, whether that's a publicly traded REIT or it's a private placement offering. Option three, of course, would be to go out and buy real estate that you own,
Mm-hmm.
whether that's an Airbnb, a residential rental, commercial rental, whatever, but that's
Well,
option 3 is to buy it yourself.
yeah, but 100,000 is not going to get you anything.
I mean, 100,000 can get you, you can get $1 million property with that.
Okay. So you're saying it would just be the 100,000 is a down payment.
Yeah.
On the property, and you get a mortgage on the rest.
Yeah. You don't need to buy $100,000 property that's debt free. No, that 100,000 is going to buy you a lot if it's your down payment.
Mm-hmm. Yeah. I mean, even 20, I would probably go 20% down. So that would basically be at least a $500,000 property that you could get.
Yep. Still $500,000,
Yeah, a $500,000 property, which, they're out there, especially, properties that are in places that people want to travel to. And you could then, of course you have to, but okay, what's the risk of this?
You have to be a landlord.
It's going to take
or you have to pay someone to be a landlord.
Yeah. It's going to take your time and attention away.
Plus interest rates are high right now.
So the cash flow's got to make sure that it's in excess of your down payment and that you're earning your cash on cash return. What are you looking at here? I'm probably looking at anywhere between 8 and 12% that you should be earning on your cash. So what we're talking about there is that if I invested $100,000 into a real estate project of some kind that I'm doing myself, that I would want to earn, at minimum 8 to 12% on the cash that I invested. That means that after all the expenses, taxes, insurance, management, and the debt service, what does the cash left over represent as a part of my amount that I invested?
Yep. That's going to be tough to get an 8 to 12% return right now.
Mm-hmm.
Very, 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 very tough.
Yeah. So this is where I would just say, well, maybe you shouldn't do it yourself then. Maybe you should just give it to an operator that would know what they're doing in that case. So I think that would be, pretty prudent at that point. Okay. Yeah. Anything else you would do with the money you can think of right now? We talked about keeping.
I think the only other thing to do with the money, if you're not investing it, is does some of it need to stay in personal reserves? Do you have your, 60 to 90 day personal emergency fund?
Well, we didn't talk about paying off any debt with that money, did we? Okay. Would we?
Yeah. If somebody has like high interest credit cards, yeah.
Okay. So it would be highly unlikely that I've seen a scenario where someone is able to accumulate $400,000 or $500,000 in cash and they have dumb debt.
Yeah, no, I agree. Usually the two don't go hand in hand.
No. So, but there would be a case that we would look at their debt scene and say, okay, let's take a look at their debt scene and see if they do have any like high interest rate debt that we'd want to get paid off.
Yeah.
And I don't know what that, I would have to be in excess of, I guess, like 5 or 6% that you're paying on because you can get that.
I wouldn't, I'd say in excess of 8% myself.
Yeah. So it would be something that, now there's two other things too that I would want to look at with that money as well. What other areas can we spend that cash on to handle any risks that we may have that we're not taking advantage of or that we're not insuring at this point in time? Okay. So what I mean by that, okay, well, I have all this cash. I don't have any long-term care. I'm underinsured. Okay. There's some other things there that you could use the cash for, right?
Yeah, and this is the tough part about a question like this on a podcast is, what do I do with 400,000? Mm-hmm. It depends.
Yeah.
Give me 10 people and they're going to have 10 different recommendations.
They're going to be a little different, but I think we are going to look at, all right, number one, is there bad debt that needs to get paid off that we'd want to pay off, or at least a portion of that? Number two, are there any risks that they're right now incurring that maybe we can handle now that we have some cash here? that we can take care of forever that would benefit that person. Number 3, what caused the amount of money and reinvest back into the business. And then 4, let's invest that money in places that are going to, provide cash flow long-term over the course of the next 10, 15 years for that client. And I think, those are the simplicities of looking at this money and where to allocate it and what to do with it next.
Yep.
So I think that's probably it.
Good. Question answered.
Anyway, so that's what you do with 400,000 or 500,000 or 300,000. So it's a good problem to have. We definitely like to see more clients have this problem as opposed to only having $10,000 or $15,000 sitting in their business checking accounts or, or whatever that would be. So it's a great problem to have, but you do have to be intelligent about what to do with the money and make sure above anything else that you guys have a plan of what to do with it. And, reinvest a portion of that back into yourself or the business or whatever created that amount. And, make sure the rest is protected, invested correctly, and it should set you up for life on that one. That's about the best ending that I think we can do. All right, bud. Anything else?
All right. See you next time.
See you guys next time.